quick valuation tips. So if you want to know how much your company's worth, if you're in a traditional business, and I classify a traditional business, one that typically gets sold as multiples of EBITDA, the smaller you are, the lower your EBITDA multiple is. The slower your growth, the lower the multiple EBITDA. So give you a quick little example. $1 million in EBITDA, pretty flat growth. You're looking at 3-4 times EBITDA. Then you're at $3 million EBITDA, growing at 10% a year. You're looking at 4 or 5, maybe 5.5 times EBITDA. 5 million EBITDA, growing at 20% a year. You're looking at 6, 7, 8 times EBITDA. So as you can tell, there really is a curve that exists as it relates to size and growth. I mean, I'm oversimplifying the hell out of that, but that really is the best way to describe it. And then there's other industries that don't trade like that. I would take SaaS-based revenue companies, SaaS-based software companies as an example. Recurring revenue is typically the multiple that's used, and deciphering that multiple is extremely dependent on the particular vertical that SaaS-based company is in. It's extremely dependent on the IP protection that they have. Just to give you some context, I mean, we recently sold a business that was doing less than $1 million in revenue and burning $2 million a year for $31 million. I mean, why is that? It makes no sense. It was because of an IP portfolio. They had a bunch of patents that were worth something to a large strategic buyer, and that exists, but it's not the rule. And what I hate seeing is everyone point to the Instagram example and say, well, they had filters and they sold for $1 billion. There's exceptions to every rule. We live in a big planet, but there are rules there for a reason.